Let's get back to the markets, which are no laughing matter, we should say. The Dow is off 243 points, maybe coming back a little bit. The Nasdaq and the S&P down more than 1%. Let's bring in Bill Baruch to talk about the markets. Okay, Bill, you think the pace of rate hikes may actually slow in December, but what about in the long term?
Well, what they communicated yesterday was acknowledging a new terminal rate, if you will, at 5 to 5.25. You go back to September, they had talked about 4.6% being the ceiling, but we all knew it 4.6% wasn't going to be the ceiling. They're going to, surpass that in the first quarter of next year. So acknowledging that, but it does open the door for continued rate hikes when the markets right now are pricing in a peak that comes in May or June and potentially a rate cut in the second half of next year. So the reaction really is Powell channeling that Jackson Hole persona that he had, after the market had some hopes lifted.
So, Bill, you think there is some opportunity, and in your notes you say you've been adding tech in recent weeks. You like some of these tech names at this price. Anything in particular?
What I will say is if you're going to be active in these markets and you're an active manager, you have to be able to pivot. The only pivot that matters is your own. It's not what the Fed pivots or not. You got to react to the market. I do like tech down here. I do think that there's some opportunity to look for tech in a very seasonally bullish time of year, some really beaten down values. Overall, outside of the big names, some of these tech reports, the earnings reports have been pretty solid. We get PayPal after the bell today. But again, being an active manager, I saw yesterday's movement and I started throwing hedges on. I'm hedging tech right now, and I'm hedging some of the commodity exposure that I have across portfolios. But I want to give myself the upside because they still remain upbeat. You're seeing things like the put-call ratio surge today and to the highest level since March of 2020. Negativity remains very excessive right now. I think that we could come out of this. We still got a lot of data, and as your co-anchor there highlighted, ISM non-manufacturing came in below expectations, though prices are higher. Non-farm payroll tomorrow. Unit labor costs for quarter three earlier today, that was lower than expected. So there's a lot of data right now to digest, and I want to make sure that I give myself and my clients upside here while protecting downside.
Very good. Wow. Can't add anything to that. Bill Baruch, fabulous stuff this morning. Thank you so much for joining us.